Well, Eric, I say here we go again. This is
Sounds like a song title.
This is something that we continue to work with clients on, and that is a question of IRAs and just the concerns they have about moving an IRA into an annuity.
Yeah.
And there's a lot of practical things, whether it's a 401k or an IRA that someone wants to move into an annuity. There's a lot of questions that come up. One is, does it even make sense to move an IRA or 401k into an annuity?
Right, and obviously yes, because the annuity is designed for lifetime income, and that's usually when people are saving from their 401k or IRA. The goal is to get money to retirement, and that's what an annuity does. Now, there's a lot of common misconceptions, I should say, with when those transfers happen when you're moving from one qualified product like an IRA or 401k and moving that into an annuity. An annuity.
I've had many times folks I've had different ones ask me, believing that they were going to have to pay tax if they put their IRA or their 401k into an annuity.
And the misconception is because they think they're taking a withdrawal.
Right.
And this is where terminology gets so complicated with financial lingo.
Right.
It's because you're not withdrawing from your annuity or your 401 or your IRA or your 401k.
It's actually like a lateral move.
Right. It's like a transfer.
Right.
Is the more appropriate term, because you're actually transferring.
Moving it from custodian to custodian, or rolling
Which is
it
not
over.
the guy at the gymnasium at the high school.
Or the janitor.
Yeah.
Or the 60-day rollover, which is popular. Right. So you can do it either way, and both ways have some advantages and some disadvantages. Sure. Let's talk about those, but first of all, let's just touch on what is a custodian.
Well, it's the guy, or in this case, the institution, who's in charge of the paperwork. They're in charge of making sure what gets filed with the IRS is appropriate.
Right.
So they've got your dollars, they're your qualified dollars,
right,
and they're reporting for you. They're telling the IRS this is what you took out.
They have accepted this responsibility that's put on them by the federal government if they want to be a custodian.
Right.
So
in order to manage qualified dollars, there has to be a custodian. So
right.
Who's in charge of the report?
Right. Then the next thing that we probably want to talk about is a 60-day rollover versus a transfer.
Well, the 60-day rollover is basically the timing. You have, when you have one IRA, if you've made a distribution, you have 60 days basically to put it into another product.
Right.
So it's a timing aspect.
Right. And the transfer, we're talking about just going from one custodian to the other custodian. And so there's some pluses and minuses to both of these. And let me try to be fair to both of these, and then you can fix me.
So each of us has a preference. So my preference has always been the custodian to custodian transfer.
Right, and mine has been
the 60-day rollover.
60-day rollover. Right.
And I like, I'll tell you, I like the custodian to custodian transfer.
Okay.
Because the paperwork basically is handled by the custodian. Right. Their job is to make sure all the numbers match up. So when they're reporting from one custodian to the next, that gets taken care of.
Unfortunately,
they're two big institutions. It takes typically they're big institutions.
Right.
It typically takes longer. You have more people involved, so you have to have a good flow of communication to make sure there aren't any glips or clips or mistakes along the way. But it's worked well for me. I haven't had a problem with it.
Right. And what I've found, because I've done both and do both, is that with the transfer process, it does take quite a bit longer.
Yes.
Typically, I hate to say this, but you've got usually two clerks working from one company to the other.
Right.
You got a lot of paperwork, and a lot of times there's just different things that happen along the way that delay or postpone. Where the 60-day rollover, if it's applicable, it's not always applicable to do this, but the nice thing about the 60-day rollover is that when the client calls the company where the money's at, has the check made out to their name, then when I say to their name, to the client's name, then the check will go directly when they receive it, usually sent some type of overnight delivery, so they've got a tracking number. Then that check will be sent directly to the company, pay to the order of the company. And so typically that process takes about a week and a half. and the client knows every step of the way where the money is, what's going on. But there is a little additional reporting at the end of the year. You have to notify the IRS on your tax return that you did a rollover.
Right, because what has happened is you've technically made a withdrawal from company one and then did the rollover process manually. So you have to, or your accountant needs to report on your tax return exactly that process took place.
Right.
And so occasionally the IRS will come knocking at your door if it wasn't filled out properly, and that's the one step that
you just want to have some documentation. You want to have the date on the check when you receive the check, and you want to have the date on when the money arrived at the new custodian.
So both are basically ways that you can do it.
Right. And sometimes it just comes down to personal preference and what the client's comfortable with.
Sure, exactly.
So, what are some other concerns that we run into quite a bit?
Well, and I shouldn't say the concerns, but there's how people are able to move dollars and when they're able to move dollars.
Right.
So
yes.
A lot of times people aren't aware that, especially the newer plans, have the opportunity to do an in-service
distribution withdrawal.
So it's you have the opportunity to actually move money out of a 401k plan.
So if you're still working, yes.
And you know, what's typically common for a lot of 401k plans, they don't give you a whole lot of more conservative options in the sense of...
They don't have the variety, they don't have the pension style income that the annuity provides.
So some people want that comfort level of being able to take a certain number of dollars out, put them in a product that they know when they turn it on for retirement, it's going to give them a guaranteed income number, and they're more comfortable with that than having those dollars in the market are at risk. So that's one aspect, the in-service withdrawal.
Right. Another thing that I'd like to bring up about the 401k, which is different than the IRA, when you call the custodian on the 401k, if you would like to do a rollover on that, you actually can do a rollover, but unfortunately they want to withhold 20%. The IRS makes custodians withhold 20% on 401ks. So it really is better, I found, in just about all cases to do a transfer on a 401k, even if it does involve delays or takes longer.
And what we're seeing more and more commonly now is, because people are changing jobs more frequently, when you're leaving one company's 401k, they usually don't want you to park your dollars there. So they want you to move out because they're paying the administrative fees and such. So a lot of times you'll see people moving from a 401k to a self-directed IRA. So you'll have those transfers going on, and that is usually, in my experience, more easily done with a custodian to custodian transfer paperwork. So as you said, then you don't have to worry about the withholding or any of those issues.
Exactly. So another thing that we run into is RMDs.
Yes. And for those of you who do not know what RMDs are, it's not some kind of weapons of mass destruction, is what it sounds like, but they're required minimum distributions.
Withdrawals that are required at a certain age.
Yes. Now, and this is one of the things that with 401ks, you do have, withdrawal requirements at age 70 and a half. Unless
you're still working.
Or and this is a new one for us that we've been talking about. You're over a 5% owner of the company, then you still have to have that RMD. So, all right, that's the little tweak.
Some tricky little laws here, and folks, we're not. Eric and I want to make it very clear. We're not accountants.
No, we don't. We don't play them on television, despite the size of the screen here.
And we don't give tax advice. What we're giving here is a general overview and understanding of how annuities generally conceptually function with IRAs and 401ks.
Correct.
So one thing that I've run into, Eric, a couple things on RMDs, I guess I should say, is that if someone is at that age, they're at 70 and a half or past that age, had their first birthday after 70 and a half, if they haven't had the RMD taken out at the present company, then they have to make sure that that money gets taken out of the IRA at the new company. So they have to make a decision. Does the company where it's at presently take it out, or does the money move over and then come out at the new company? And it's fair to do it either way.
Right, and it's a matter of reporting.
Right.
And of course with IRAs, you don't have to, if you have multiple IRAs in different locations, you don't have to take it out of each and every one. You can choose to take it out of just one
Right.
one location versus all
You
the
figure
others.
what's owed
Yes.
in your RMD on each annuity or each IRA account, and then you can take it, add it all up, take it all out of one account.
Right. So, and I think, and this is where people always say, well, how much am I going to owe? And we should say RMDs are calculated based off of basically the end of year of
Right.
the prior year, and it's based off of your age and a percentage.
Right.
The formula
It's-
the IRS puts us out there.
Yeah, it's in publication 590, and the unified tax tables, and there's like 3 different tables depending on the age of your spouse and that type of thing. So one thing that I found, Eric, that a lot of times is a misconception on the RMDs. A lot of folks believe that once they turn this magic age, you know, of about 71 years old, that they have to take large amounts out of their IRA and pay the tax, or they have to take it all out, which is really a misconception that I wouldn't think that would be out there, but I hear it quite a bit. And the fact of the matter is that your initial first RMD is about 3.65%. So it's we always say 3.5%, but it actually is about 3.65 when you figure it. And so and then it graduates up from there.
Right.
And rather than, I've always said, you know, if the IRS has a choice, folks, what do you think they're going to do? Do you think they're going to make it the formula very simple, like just tell you the percentage rate, or do you think they're going to make it complicated and make you do math with a divisor? So they give you a table, a divisor, and that withdrawal rate goes up with your age, so that, you know, each year you're taking a little more out, so that, you know, by the time you're up in your 90s, you're getting your IRA pretty well depleted.
Yeah, and this is where that custodian comes into play.
Yes.
When you're working with a company that you have an IRA with, if you have questions about the amount you need to take out, contact the custodian, because they'll do the math for you, because they want to keep you in compliance as well. So.
Well, what I want to go back to, Eric, is, does it really make sense to put an annuity into an IRA? Or to move your IRA into an annuity? Yeah,
both ways.
Yeah, that's right.
Yeah.
Bob can be spelled backwards and forwards.
And this is what, you know what, for me, I like the idea of taking IRAs and 401ks that have been basically, they've been saved for the purpose of retirement income.
In most situations they have.
And that's what I'm saying. If they've been saved, and that's the intent
Yes.
for these dollars,
Right.
what does an annuity do? It gives you lifetime income for that portion of your money. Are we saying you move all of your IRA dollars or all of your 401k dollars into an annuity? No, not necessarily. It's taking what you need for that foundational aspect.
That has to be determined.
Create your own personal pension. You know, everybody likes the idea of having guaranteed lifetime income.
Right.
I don't think anybody's ever said, oh, that sounds awful.
Well, most people choose it when they have that option
Right.
and they're leaving employment.
You know, I have a family of educators. They all fight for their pensions. They love their pensions.
Right.
And that's, you know, one
Right.
aspect that people miss now
Right.
in this 401k world. They don't have that pension. The responsibility is on you. Well, this is one way of taking some of that responsibility and making it shared
Right.
by having insurance on your life. You're
Right.
basically- You're
Right.
guaranteeing
Right.
your income for
So when someone chooses to put their IRA into an annuity, one thing that they should be aware of, and that is that you're not doing it because you're looking for tax deferral. You already have tax deferral.
Right.
So you're doing it for other reasons. You're doing it because you want security, you want a guaranteed income, perhaps some type of a hedge against inflation.
Right.
And so that's the reasons why you would do it, the sound reasons why you would do it. And I believe that the idea would be to put as little as possible into an annuity to create the foundational income that's necessary. So it's good to be able to calculate that out, forecast your cash flow needs, and know that you've got this portion of your portfolio set up for your income.
Right. It's covering that foundation, so that you're comfortable. You
Right.
know you've got that covered. So,
Right.
So sounds like an excellent choice.
I agree. Thanks for joining us, folks.
You have a wonderful day.